North American equity markets are mixed to flat. This is as investors assess the potential impact of President-elect Trump's proposed trade policies. The spotlight in some ways will certainly settle in on natural resources. There's no question there. So how is Fidelity navigating these trade uncertainties? And where is our next guest finding opportunity in today's market environment? Happy to say joining us here to unpack all of this and more is Fidelity Global Natural Resources Portfolio Manager, as well as Canadian Institutional Portfolio Manager, Joe Overdevest. Well, Happy New Year to you. Good to see you.
Happy New Year, Pamela.
We've got Joe here. Send your questions in for Joe over the next half hour or so. He'd be delighted to answer as many as we can fit in. Shall we begin a little bit with what is facing everyone here right now? And these are sort of the big questions. You go from macro, and sort of trickle down to the country's perspectives with trade uncertainties. Do you want to begin a little bit, Joe, with either sentiment or taking a look at kind of the monetary story right now?
Yeah, I think let's talk about the big four pillars. I think Yuri and Timur does a great job of doing this, but the first pillar is monetary policy. Right now, as you probably saw, there's a lot of volatility the last few days because monetary policy expectations are being lowered, as in how many cuts we'll have. Give or take, about one cut is being priced in Canada and the U.S. So the monetary policy outlook shouldn't change drastically as we stand today. Very dynamic environment.
For the Fed.
For the Fed, yes. Yeah. Number two is that, fiscal policy. I think this is where it's the biggest unknown because we're having, on both sides of the border, potential change happening. And in terms of the big one would be tariffs, immigration, cost cutting, deficit spending. So that's probably the most uncertainty of the pillar right now. We can dive into that, is the fiscal policy outlook for both countries. The last two would be, of course, earnings and valuation. Earnings outlook for Canada and U.S., probably about double-digit earnings, decently. So that's pretty good growth. And what's happening on the valuation side, we have to respect. Both countries have had very good years. We have 20% plus returns last year in Canada and the U.S. So valuations in the U.S. probably around 22 times earnings on average, and in Canada probably around 15 times. So expectations have gotten a little higher. So when you add all four of those up, generally, if three of the four look pretty good.
Yeah.
It's that third one, the second one is giving people a little uncertainty. But the Goldilocks would be there aside from the fiscal policy.
Right, aside from which is everything.
Yes.
Which is everything. So let's go there. I mean, you're going to be looking at it. Obviously, the government policy is there. That's the piece. That's the question mark. The companies themselves, though, would you, if you were leading a company, and you're speaking to a lot of these company leaders, about to spend, about to do deals to spend, you're thinking infrastructure, thinking almost anything.
Yeah.
Are you going to just pause to see where all this lands?
Yeah, it's very interesting. January is a very busy time for us here as part of our investment process here at Fidelity because there's a lot of conferences. January and September are a big one. So just last week alone, I probably saw 35 different CEOs, either by phoning into different meetings or going in person and seeing them, in particular at conferences. What's on their minds? What's on their minds right now is probably a pause, like you said. Is that, yes, if a capital project's already in place, it's very disruptive to stop it.
If it's already paid for, that's one thing.
That's different. But if you're doing new investments right now, you're just waiting to see as the cards get churned over. I think Will Danoff does a great job explaining this. As an investor and a CEO, you're waiting to see how the cards get churned over to where you place your next bet. And in particular, like here's a simple one. If you're an auto company right now and you're like, I want to do my next auto plan. Could be EV, could be not. That is, the subsidies on EVs are changing, but also just, geography-wise, does it go to Canada, go to US? It would probably pay to wait right now to see some clarity because the federal government on both sides is changing, yes.
So, I mean, this is investment, Canadian investment, domestic investment in companies, but it's also, if you're sitting even outside of the US, thinking to invest in Canada in some way, the foreign direct investment, that would also pause, would it not?
Yes, I think definitely when you're looking outside, because a lot of this investment can move, and especially it looks at the number of things, incentives, tax structure, because again, the Trump administration would potentially like to lower taxes. Our potentially change here could have lower taxes too, depending on who wins. So again, it's a number of things, and even little things I would say when we dive into energy is, we just talked to a lot of energy companies right now at a big energy conference. The global energy players said, one of the biggest things that probably held them back the last few years of investing a bigger amount in Canada, because they've actually been selling, not buying in Canada or investing. They've been a net outflow of capital, is that one was egress, which means essentially pipelines. And we've sold that with, on the margin, LNG Canada for gas and TMX for oil. So that's making them feel more comfortable. But to your point, number two was probably the federal government. They said for the last 9 years, they did not feel comfortable investing, for the most part in Canada, in a major way, worried about CO2 being taxed, maybe just like permitting in general. So they think potentially with a new government that could maybe make them feel more comfortable with investing in Canada on the energy side.
So in that way, that's been, it sounds like you're saying, on hold actually for years. Yes. So again, wait a little longer, I guess, is the idea.
Yes.
But then there's other projects that are actually in the midst or about to be inked, for instance, and that stuff is going to be held. How do you look at this? So that's one industry. We'll talk more about that. But what other industries? Can you go industry by industry, or do you need to go company by company?
I think industry, it all depends. I think, some companies are, let's go by industry. Like one of them is like even AI is touching, right? So data centers. One of the biggest things that, Alberta has been very open about, like, let's bring the data centers here, we'll provide the energy, is that,
it's cold. You don't have to worry about them getting overheated. It's freezing.
Exactly. But one of the problems is if you're sitting back as an AI, data center person who's going to have the data there, is if there's an America First policy, and, do you want to make sure it's in the U.S. for incentive reasons? But also, number two is that, it's a subtle thing, but taxing, for instance, the social media players, some of them are the Mag 7s recently, our Liberal government did that maybe made them a little scared to saying, like, if I put my data center in your country, are you going to tax it differently? Are you going to be very aggressive about it? So I think in the European actions the last few years, people are very sensitive about moving data across borders. So I think for sure there'll be data centers here in Canada, but moving that data across a border, it seems like data centers will be in the areas which will actually be used, as opposed to like moving too much across borders. So I think that the President Trump administration definitely wants an America First policy, which will draw capital to probably on the data center side more so in the U.S.
That's fascinating. What would need to change in the oil and gas industry to see real investment?
I think to see real investment is an interesting discussion. We can even pull it to North America, is because when you saw you saw a lot of things being said about the incoming administration U.S. saying, we'd like to drill more wells, and the 3-3-3 policy, 3%, in terms of growth, 3 million barrels per day, 3% deficit. Well, when it comes,
it's a nice simple.
It's simple.
It's a nice simple.
They stole it from
line.
Japan, but yeah, it's nice and simple.
That's right. They stole it from Japan. That's right. Yeah.
But it is smart from a it's a simple message to be easily repeated by the people. But when you actually ask oil and gas companies, will things change? And Canada or the U.S., and I think you're getting almost the same answer, is that if the Canadian government has a change here with a new government, and of course we know who's coming in the U.S., both Canadian and U.S. players on both sides have said for North America spending, probably don't see a lot of change. And the biggest reason why is that Canada in particular is really tough to add, new permitting, and they do think potentially that changes. But the bigger thing on both sides of the border is probably the shareholders. The shareholders have actually told them, dividends and buybacks, we don't want you to grow a lot. There's still some uncertainty about how much demand for oil is needed because OPEC has a lot of spare capacity. So most people are saying, even the major Permian producers, some of them are only growing 0 to 3%. And so I think that's the biggest, harbinger right now. I don't see faster growth.
Joe, are all the natural resources is what you do. Are all the oil and gas companies trying to figure out how AI will make them more efficient?
I think almost every company we talk to is using AI in terms of as a test case in almost everything they do. Yes. Yeah. And I think AI for the energy companies actually, again, we had a global energy conference. It was amazing seeing the difference, the effect there. So one of the effects is uranium. Uranium never used to be at the Goldman Sachs Energy Conference. This is, again, 800 investors.
It's a new invite.
Yeah, exactly. We got invited to the party. They got invited.
Make a new address line.
So 100 CEOs will be there at least, and they had never usually been invited. And then even Chemical, which is our course here in Canada, was the 8th most requested meeting for 101. So this shows a change. But also, I'd never seen this before. I've been going there for, could be 15 years now. It's in Miami.
Oh, yeah, okay.
So I'd never seen this before. It almost makes me smile how things have changed. We used to have coal companies there. Now we have utility companies, midstream companies. And because of just the AI demand, or demand just for energy in general and power, and so power will be, that means natural gas, that means uranium, that means wind, solar. Utility companies.
Still coal?
Pardon?
Still coal?
It's coal on the margin.
Still there.
But you definitely see it, it's
they
not
have a smaller
growth
booth.
Yes.
Yeah.
Well, actually, it's funny you say on the main stage, I think there was no coal companies for the first time.
Is that right?
Yeah. So, but I would say though, the power demand is a big deal that's driving from particular data centers.
Fascinating. Okay, so we sort of talked about the fiscal and the macro to an extent. Let's get into sort of the valuation story and just a bit more on that. There are many that would argue things are a bit frothy and toppy. Not everyone sees it that way, but there's a question about how much has been pulled forward through last year in various companies and the effect that's going to have on markets. And I would just ask how that's going to affect the TMX. Like, how's it going to affect the Canadian stock market?
Yeah. We look at the Canadian stock market, it doesn't look frothy.
No.
You know, obviously, we've had a big move up in the stocks themselves. We had earnings revisions as well. But when you look at around 15 times earnings, many of these companies, when you look at sector by sector level versus history, they don't look extreme. Obviously, if monetary policy changes a little bit or tariffs come in, that can change the multiple. Multiple is also a reflection of sentiment, of capital flows. That for sure can change it. But the actual fundamentals, when you look at, you know, who is trading at a higher multiple, being maybe tech companies, or a lower multiple being energy companies, you don't see really extreme valuations at that point. So really what's going to drive this going forward is it probably earnings growth. If we have a strong earnings growth story, I don't think the multiples will be a big hindrance at this point in time.
Okay, but would they be more additive in Canada? I mean, there's sort of this question of you have to have a very steady hand as an investor doing this, but knowing that things may be overvalued in the US, I'm just positing this, and less so here. I mean, what could that mean?
Look, I think when you look at active management, this is a perfect example.
Exactly.
because
do it.
Because it's a very dynamic environment. Even our conversation, if we have this after, you know, the February 1st kind of thing, it could be changing a lot kind of thing of what's the available and the opportunities out there. But as we stand here right now is that the Canadian market, yes, it doesn't look extreme in terms of valuation. I would say though, give full credit even to the US though, when you look at their 20 plus times multiple, is because they have different type of companies. A lot of healthcare, a lot of tech. And when you actually look at the fundamentals of those businesses, again, looking at what they can provide from a discounted cash flow basis the next few years, those multiples in many cases don't look extreme either kind of thing. So we are a little bit more just in terms of our sectors drive a lower multiple stocks. But even in that context, yes, there has been in the very short term a negative bias towards Canada, in particular because of tariffs. So if that gets resolved, there's a potentially a catch up.
Resolved, but they're coming anyway. It's a case of to what degree. Is
Yes.
Is that what you think?
Look, I think in these political situations, one of the things that, you know, I try to remind the analysts too in particular is like, don't get emotional and don't get political. We're here to make money. We're not here to be political experts.
You just want to measure them and see what it means to the company.
Because sometimes you hear people, especially pundits on TV, you can tell they have a certain undertone of their own political view and making their business views kind of thing. We're here to make money. We're not here to make a political view. And so when it comes to the actual election, in particular in the US, what's happened afterward, I would say is that with President Trump and with many other people and politicians, take them seriously, don't take them literally. And what that means is that, you know, tariffs, or that he will do something. There's some people say like, oh, that's foolishness or whatever like that. He won't do that because it makes no economic sense. He's
the president of the United States. I think you should take him seriously.
Exactly. I think apparently you said it very well. You have to take him seriously. That like he has the power to do that. But number two is that do we take him literally? As in like, is there 25% tariffs, or is it a negotiating tactic? And as we get closer, it gets changed. We give something, they give something into negotiation. That is not on the realm of possibility. We have a 4-year track record of what he's done in the past. So again, we'll take him literally. We won't maybe take them seriously. We'll take them seriously, not exactly literally, but we'll also be very watchful with our investments and what exposures we have for sure.
Have you ever had to be this watchful to policy?
You and I have talked about this a while. It seems like in history, it seems a pretty extreme event. It's tough to recall a time when you have an incoming president in the U.S. making this many uncertainties to the U.S. and the Canadian market, or even world markets.
Yeah.
Again, we always joke, like, you know, remember think of like Clinton or Bush coming in, like debates were nuances. If anything, like the market hardly moved. And now you're definitely seeing that. And I think this is an example where we want to have strong investment thesis, but we're always testing it. And this is an example where as the cards get flipped over, we have to be willing to act, and things could change.
They have a strong investment team running sort of everything from the Treasury to the whole economic side of the incoming administration. What do you make of that? I mean, in theory, that sort of is a ballast.
Well, how about this? I'll take it from the CEOs we've met with so far.
Yeah, what do they think?
Yeah, and CEOs across multiple sectors, Canada and US, are generally excited for what the new administration will bring. I'll give it one little pause.
Yeah.
The tariffs, of course, if you're
not excited, but
if you're a Canadian company, that's probably your biggest concern right now is the tariffs. From the Canadian banks to the Canadian energy, everyone's got their eye on the tariffs. But within the actual U.S. government, U.S. companies that we talk to, they're generally excited that at least business will be easier to do, M&A will be easier to do. To expect that potentially more mergers and acquisitions will happen because for the most part, the CEOs would say last 4 years in the U.S., it'd be really scary to do an M&A deal because of all the paperwork and the eyeballs on you. They would drag it out. They may deny you. And so no one really wanted to do that. So they think business in general will be a little easier to do. They think M&A will potentially be easier to do. And thirdly, they're hopeful that this administration will increase growth in GDP. Because again, from a business leader perspective, that's what you want. But even the U.S. players, the U.S. CEOs would say they are worried a little bit about the tariffs. Because tariffs are even not, depending how they're done, can also be a negative for the U.S. consumer.
Right, absolutely. Because they may still buy those things,
yes,
but at a higher price, and that could have a knock-on effect.
And inflation and monetary policy, we're back to square one.
Yeah, how many cuts in the end? Take us back to the deals. I mean, for instance, one of the many theses for why financials in the U.S. have done well and Canada have done well is this sort of expectation for the investment banks that there will be more deals. It seems to be consensus there will be more deals.
Yes.
One of the government reasons for not putting certain deals through seemed to be foreign ownership. Mm-hmm. Is there a nuance there that maybe North American ownership is moving to the front of the pile? There's just less welcoming of foreign ownership from other corners of the earth?
I think as you and I have talked before, the friends and enemies of the U.S. and Canada have changed over the last few years when we first started doing this. And so I do think, though, that, certain countries, China is a sensitivity, definitely for the U.S., and now even Canada, which was in the past. I think that also, too, an America First policy here multiple times. So I think you're going to see more of that. And it's even interesting, too, what's going on in different regions, like the Panama Canal. For most people, that's not a top headline. But it's just interesting how now the U.S. is stretching their views, not just from in the borders. And even Greenland is a small name, and it's not a big deal for business, but it just shows they're exerting their probably pressure on certain countries that wasn't there before. Yes.
Mm-hmm. I mean, Panama is the gateway to the Pacific, so you can see why it would be.
Yeah.
Okay, but will there be more interest in deals being done within North America?
Yeah, and I think the big reasons, the drivers why we expect more M&A, but more importantly, it's always great to hear from the CEOs themselves. We talk to private equity companies, we talk to majors, and then we talk to some of the smaller companies, almost across the board, more M&A. Why? Interest rate policy, again, totally changed. We live in a very dynamic environment, but right now, we had a lot of movement in the interest rate the last kind of 2 or 3 years. It seems like the variability in that is a little less. Number two, change in government. It's almost across the board, everyone says, this feels a lot easier to actually get a deal done as opposed to being denied. And then I think thirdly is that, everyone was waiting for the recession the last few years, right? You and I have talked about this a while. It was like the recession everybody was waiting for. We went to inverted yield curve, it has to happen. And at this point in time, it's not really happening. So the CEOs generally feel okay because they're the global economy, especially in the U.S., is probably 3% growth, 2 or 3. Here it's 1 or 2%. That gives them confidence. When the economy is weak, it does not give them confidence. Yeah. And last, the fourth pillar, why M&A you potentially see more, the private equity players. There was a huge amount of capital they deployed. They need to get off.
They need to exit.
They need to exit, and there was a pause there. Yes.
So whether they sell or whether there's more IPOs, which it appears they're also forecasting. Okay, here's a great question about deals. Do you see the Keystone Pipeline this is the XL, finally coming to fruition? It was obviously canceled by the Biden administration. What would that look like economically if authorized on both sides of the border? So chances?
Chances are high that it will probably be brought up by the President Trump, as in one of the things. Chances of it going through at this point in time, very dynamic environment, is low. But the interesting thing is this is where you can trade something. You know what I mean? So what if we traded this for something we get in return. So that's why
Right.
I'm saying it's a very
Like
dynamic
what?
environment. Well, I'd like lower tariffs. That would be
Okay.
number one, exactly, right?
So put it through, maybe lower tariffs.
But I would say there's a lot of risk in that one because of what happened last time. So there would have to be a lot of guarantees that this thing can't be pulled under the rug 4 years from now. So that's what, I think that the companies involved are very unsure, very nervous when it comes to this. There would have to be guarantees on both sides of the border.
I see.
And what would it lead to, of course, is potentially, our pricing, our oil pricing going a little higher because we could get to new markets, yes.
Yeah. Super interesting. Okay. Another one, what is the expected increase of oil and energy requirements with economic growth in developed countries? Do you understand that? Okay. What is the expected increase of oil and energy requirements with economic growth in developed countries? Let's go with, economic growth in developed countries on the oil and energy side of things. Do you see, we're actually swimming in it.
Yeah.
In fairness, we've got tons. The spare capacity story is...
Yeah, it's a very good point. So where are we in oil in general? So oil is, for the last 3 years, generally around $70 to $80. And why that makes sense is that, again, we were just talking to a number of oil and gas producers from the Permian and some of the bigger players. They're probably $55 where they kind of like change their plans. But the smaller private operators is around 70. So it kind of makes sense where someone in Texas who's private maybe pulls a little back there. 80, it makes sense why we're kind of hitting that level last few years, is you can see OPEC seems to be want to release oil around that level. So that, and as you said, we have a lot of spare capacity right now. So I know there's a lot of uncertainty about sanctions in Russia, Iran sanctions. That could be a short-term bounce in oil price, don't get me wrong, but we have to respect there is still a lot of OPEC spare capacity they can release. So 70 to 80 is a decent range for many developed countries to survive. Like, it's not a big deal. But I would say if you were the Fed or any central banker, oil is probably one of the biggest things you look at, because we've over the years, when oil starts going to 100, they start getting worried because it's such a big driver of inflation.
Right.
And it goes into so many different products. So again, if we have a Goldilocks environment, $70 to $80 is not a bad environment at all. And for the companies themselves, it's a great price to produce very good returns.
Do you think there'll be an oil shock? That is historically what happened, and it obviously was the underbetting of all of our economy. So it was massive, but it's kind of a different story now.
It seems right now low probability. And so on the supply shock you would have is in the past, of course, in with the Middle East there were supply shocks. A number of them over the years, but the big ones would have been in the 70s. It doesn't seem like there's something going on in the Middle East that would just pull a whole bunch of barrels off. If anything, the incoming administration in the U.S. seems to be wanting to get closer with the Middle East, not further away. And different parts of the Middle East, of course, not Iran, but probably more in particular Saudi Arabia. Demand side then, what would be the shock there would be like, of course, again, a China or India just growing so much that we can't keep up.
Okay.
China is actually, if anything, pretty anemic growth versus what they've done in the past. Like, it used to be 10, now we're debating, are they actually going to hit 5? I think the one thing we have to watch for resources in general is the slow move up in these commodities that we don't see, or the market doesn't appreciate. And that is what I just told you before. Oil and gas investors are telling oil and gas companies, don't grow. I just want dividends and buybacks. The metals companies are having a tough time finding places to actually grow, and build new mines. All this here, while the global GDP continues to grow, we continue to have demand for energy and metals, but the supply is not keeping up. And it's more of like, in terms of a shock, it's more of a slow, gradual move. But that's one you have to really watch for, because reversing that can be very painful. I think we hope we have like enough supply in the future, but again, it's one of the more interesting things was this anecdotal oil and gas executive. His son was in the oil and gas business. He left to join the investment industry, right? And it's just like hearing the amount of people going into, for instance, petroleum engineering schools is down drastically. Some of these schools are actually closing. And again, there has to be, you just have to respect, there's some long-term implications. Again, we talked about before, that the handoff to renewables may not be a clean handoff.
Right, absolutely. We got to pay people more to draw those smart minds back into the oil and gas and other industries like that, if that's the case. In your opinion, Joe, what do you think Canada can do to address our ongoing productivity issues?
The productivity issue is a very good point. I'm glad it was brought up, because one of the things that we talk about is like immigration is being brought up on both sides of the border.
Yeah.
And I think that's very important for the audience to understand is immigration generally helps the economy. And the reason why it helps is because when people come over here, they get a cell phone, they buy a car, they buy a house, they buy things. And so when you actually look at Canada last year, we've had a huge amount of immigration. The GDP per capita is not as attractive as you think it is here in Canada, and that's productivity. Our productivity is quite weak. In the US, productivity is actually still going up and moving up very positively. Us, we're definitely trailing, and it is a concern. I think number one is if you want productivity or GDP growth, you want businesses to invest, back to what we originally said. So certainty of fiscal policy, as in maybe taxes go down. At the very least, the concern, I think from a lot of businesses, are taxes going to go up, right? So clarity on fiscal policy, number one. Number two is that, I think in longer term, you do want to see some, growth in terms of innovation in tech investing. And that's the one thing that's really interesting. The U.S. is definitely leading right now. Mm-hmm. Hopefully we don't get too far behind, because if we really want to do productivity, a lot of it is actually potentially right now with AI or just
deploying
tech in
AI.
general.
Yeah.
Yes. And you have to at least respect that. So clarity from a government to be business friendly and a focus on technology usually are two big pillars of how we can increase our productivity.
So just a couple minutes left, but for investors, Canadian investors right now thinking like, oh my goodness, should we just sit in cash for a little bit? I mean, What is the argument for being less exposed to all these issues and investing through it?
Great question. I think number one is understand that you can always be emotional in the moment. There's always these moments where, Ukraine crisis, global financial crisis, COVID, it's very emotional at the time. Try not to be emotional, number one. And I'll explain to you why. Is because number two is that let's embrace, do you really know the timing of this? So what I mean by that, you can easily say, I'm going to go into cash because I don't know what the tariffs are going to be. And all of a sudden the tariffs come out and they're less than people thought they were going to be. Right. And the market goes up a huge amount and you're like, oh yeah, that surprised me. Exactly. Do you have an edge on President Trump deciding on what the tariffs will be? Okay, so if you don't, you have to respect that, number one, why'd you just go to cash? So try not to be emotional. Respect, you probably don't have an edge on politics. And number three, more importantly, is that the power of compounding, the power of investing with great companies. All these companies have faced headwinds at multiple times in the past. And at the time, it looks like, oh my goodness, this is the end. And in the end, what you're doing with investing, you're investing with great companies and letting them grow their earnings over time. And as stocks follow earnings, your investments should grow as well if you've chosen wisely.
Okay, fantastic. We'll leave it